If you're a small business owner that's planning for retirement and you file as a Schedule C or a partnership with a K1 and you don't have any employees, in this video, we're going to talk about a solo 401k to maximize your retirement planning contributions. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. The solo 401k, which goes by a ton of different names, including the individual K, the uni K, the solo 401k, and the small business owner's 401k. Now, it goes by all these different names, but they're all the same plan. And it is a small business retirement plan if you have no other employees. And the calculation for the contributions to the solo 401k are a bit different than if you have an S corporation. So while you can still have a solo 401k as an S corporation, the calculation to maximize your retirement planning contributions are a little bit different. So this video is for the small business owner that files as a Schedule C or a partnership with a K1 and no employees. Now, before I get into the calculation with the solo 401k and how to calculate your contributions and also maximize your contributions, I want you to know that the solo 401k's rules have recently changed. They actually changed in December of 2019, and it made it a lot more attractive for a lot of small business owners. And the big change is that in 2020 and beyond, you'll be able to open and fund a solo 401k all the way up until the tax filing deadline, including extensions, meaning all the way up until October the 15th of the following tax year. Now, that's a lot like the SEP IRA, which could still be open and funded all the way up until tax filing deadlines, including the extensions. And there's a good chance moving forward that a lot more small business owners will begin to use the solo 401k to make that last minute contribution, mainly because in a lot of situations, you're gonna be able to fund more into a solo 401k than you could with a SEP IRA. And because as small business owners, we wait until the last minute to do just about everything. So if you wait until the last minute to make those retirement planning contributions or open up a retirement plan, a lot of times the SEP IRA is the only option. So that's why it gets recommended so often. But with those recent changes with the act called the Secure Act of 2019, those changes will make the solo 401k a lot more attractive for a lot more small business owners. And if you want to know more about the Secure Act of 2019, I did a previous video earlier in the year that I'll leave a link in the description at the bottom. Now, before we go through the calculations on how to maximize your contributions and just basically calculate your contributions into the solo 401k, I want to point out that there are a ton of calculators out there that you can use to figure out how to maximize your retirement planning contributions. But it's really important that you go through the steps to not only make sure that your math is correct, but also to making sure that you're using the right numbers. So here we go, and I'm gonna pull it up on the screen. Now, here's the deductions worksheet for the self-employed. Now, this is directly from the IRS's website, but I did go in and edit these fields so we can fill it in together so you can see it clearly. So it won't look exactly like this if you do download it from the IRS's website. Now, going through step one, what you're gonna need is your Schedule C. So your Schedule C or your K1. Now for this walkthrough, I'm gonna use a Schedule C just to show you exactly where I'm getting these numbers from. So as you're following along, you know exactly which numbers we're using. So from our Schedule C, we're gonna wanna look at line 31, and that's gonna be our net profit. Now for this walkthrough, I'm gonna assume that our net profit is $100,000. And you can get your net profit from actually two separate places. So it'll be on your Schedule C, or if you want to pull up your Schedule SE, which is your self-employment tax. And if you look down on the Schedule SE for self-employment tax, you're going to see that it's going to show the net profit on line 2. And for this walkthrough, we're going to use $100,000. So I'm going to put $100,000 into our deductions worksheet for self-employed. So 100,000. Now in step 2, we're gonna enter your deductions for self-employment. So what this is 1/2 of your self-employment tax. So you can get it actually on the same form. So from your self-employment tax on line 6, you're gonna get that 1/2 of self-employment, which is $7,065. Now, the reason that you're doing this math is because it is deductible. So self-employment tax is both the employer and the employee side. So self-employment tax is 15.3%. And if we take half of that, that is the expense on the employer side. So that is the deductible portion, and that's why we're putting it in here. So it's 100,000 up here on line 1, then line 2 is 7,065, and then line 3 is our net earnings from self-employment. So it's simply taking step 1 and subtracting step 2, which is our deductible portion, leaving us with $92,935. So here's where it gets a little confusing. On step 4, you can contribute up to 25% into your 401k, but as a self-employed owner, because you're making that contribution, it's also an expense. So the way to do the calculation for the contribution is a bit of a formula. So here's the formula for the rate. So it's rate, which would be 25%, and you can see it right there. And then it's going to be divided by 1 plus that same rate, which is 1 plus 0.25. And if we break out the calculator to show you what that looks like, it's going to be 0.25 divided by 1.25. And that's how we're getting our 20%. And that's going to be the maximum contribution. Now, if you had decided that you wanted to do 8% or 8.5% or 9%, whatever percent from 1 to 25%, then you can just plug in those numbers. Now, most small business owners that want to maximize their contribution will use the full 25%, which in this case works out to 20%. So I'm going to explain that one more time because I know it gets super confusing. So you have your income minus your expenses, and then you're ending with your net profit. But now, because we're making a profit sharing contribution, which is considered an employer expense, we have to account for it. So that's the formula we're using. And that's why there's an adjustment to the contribution rate. So while it's technically still considered 25%, the maximum amount based on net profit is 20%. And then we're going to multiply our $92,935 by 20%. And that's going to give us the maximum profit sharing contribution based on our $100,000. And we can make a total profit sharing contribution of $18,587. Now you might be thinking, why can't I just multiply 18.587%? And that's because Social Security has a maximum limit and that goes up each year, whereas the Medicare side to the self-employment tax does not. That has an unlimited amount of dollars that it will be taxed on. So that's why you can't just use 18.587%. Now moving to step 6, the maximum amount of income that can be used for this calculation is $280,000. So if you earned $500,000 for the year, you couldn't use that total amount in this calculation because the maximum amount of income is $280,000 for 2019. Now that's going to go up to $285,000 for 2020. And that also means the maximum contribution will go from $56,000 for 2019 to $57,000 for 2020. And now in step 7, we're going to enter the smaller of steps 5 or 6. So we're going to put in our $18,587. And step 8 just has our maximum contribution, just so we can see it there at $56,000. And then if we go down to step 9, enter the allowable elective deferrals. Now, this is going to go up to $19,000. And the reason it's asking you the allowable amount is because if you had another 401k with another employer, then the maximum amount would be aggregated. So let's say that you put in $10,000 into the other 401k, then the maximum amount on the employee side that you could do into this 401k would be $9,000. So they can only add up to $19,000 for 2019. And that goes up to $19,500 for 2020. So we're going to put in $19,000 in there because we're going to assume this is our only plan. And then you can see this number adjusted right there to $37,000. Where did it get that? It subtracted $19,000 from our $56,000 max. Basically what it's saying, the maximum amount in addition to our $19,000 is another $37,000. And then we're going to subtract lines 9 from step 3, which gives us our $73,935. And then we're going to divide that by 2. And then on step 13, we're going to enter the smallest of step 7, 10, or 12, which will be our $18,587. And then on step 14, I already had to do the math for us, but it subtracts step 13 from step 3. Then we're going to scroll down, and on step 15, we're going to enter the smaller of step 9 and 14, which will be our $19,000. Then we're going to subtract step 15 from step 14, leaving us with $55,348. Now the next step is going to have to do with catch-up contributions. And that is if you're 50 or older, you can make an additional $6,000 contribution for 2019 or an additional $6,500 contribution for 2020. Now, if you're under the age of 50, you cannot make this additional contribution. So if you are over 50, move on. Otherwise, you can skip to step 19. So you can see I did the math here, and we'll just go through that contribution really quickly. I'll show you both ways. So we have our $55,348. Enter the catch-up contribution, if any. Don't enter more than $6,000. So if we put in $6,000 right there, and then enter the smaller of 16 or 17. So we'll put in $6,000. And then we're going to add steps 13, 15, and 18, which gives us the $43,587. And then on step 20, these are going to be our Roth contributions. So we can put in 0 right there. So this is the step with the Roth side of the 401k. Now, if you make Roth 401k contributions, then that would be an aggregate amount against your $19,000. So for example, if you put in 10 grand into the Roth side, you can only put in 9,000 to the traditional side, or vice versa. The two can only add up to the full 19,000. And this is the same for traditional IRAs and traditional Roth IRAs. So you can only put in a maximum amount of 6,000 or 6,500. So that is the maximum amount combined. So it's the same thing with the 401ks. So if you did make Roth contributions, then you have to subtract it, as the maximum contribution can only be 19,000 on the employee side. Now, it cannot come from the employer side. That was the profit sharing contribution. Those were only traditional 401k contributions. So we're going to put 0 for that. And then on step 21, subtract step 20 from 19. We don't have anything for step 20. So that's just going to be our $43,587. Now, if I go back up here and I put 0 and 0, and now you can see it flip to $37,587. So that is if you're under age 50. Then your maximum contribution with a net profit of $100,000 is our $37,587. And that breaks out simply to our $19,000 employee deferral and our profit sharing contribution of $18,587. So combined, it's $37,587. So what this all means is that if you have a net profit of $100,000 and you want to maximize your retirement savings and reduce your taxable income, then making this contribution will reduce your total taxable income by $37,587. So this can make a huge impact on your taxable situation, because every dollar that goes into the 401k is reducing your taxable income by that same exact dollar. And while at $100,000 of net profit, you wouldn't qualify for a traditional IRA in addition to your 401k, but you could also qualify for a traditional Roth IRA. But of course, that depends on your other income. And that is how you do the calculation for the self-employed Schedule C filer partnership with a K1 calculation for your solo 401k. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.